Your top 10 buy-to-let mortgage finance questions for 2021. We asked you guys for your most burning questions for raising finance for investment property purchases in 2021, and that's what we're going to cover in this video. On the screen are the 10 questions we're going to deep dive in. You can advance to the relevant question if you want to, or stay tuned and watch the whole lot. We're going to explore this subject with my mortgage broker, Akhil Mair, so stay tuned. So my name is Ranjan Bhattacharya. I'm a property investor and developer for the last 30 years. If you're new to this channel, make sure you subscribe and hit the bell icon because we put out new videos each and every week, and they're all dedicated to keeping you on top of your property investing game. Today, I'm joined by my mortgage broker, Akhil Mair. Akhil, welcome.
Thank you. Nice to be back again, Ranjan.
Welcome back. And we've done several videos together. Some of them have had some great views answering. We did one covering 23 most common buy-to-let questions, didn't we?
Yes, we did.
It's had a lot of views. We'll put a link up on that. So we're not that covers all the basics really for property investment mortgages. So you can go up there and see what we've covered there. But in this video, what we're looking at is specifically, we've had a turbulent year in 2020. We're going to look at the buy-to-let mortgage challenges, if you like, faced by property investors in 2021 for raising property finance. So Akhil, just tell us a little bit about yourself and your mortgage brokering firm and all of that so that they get an idea of what you are.
Thank you.
Who you are, I should say.
Well, thank you for having me again, Ranjan. So we're a team of experienced and specialist mortgage brokers. We're a team of 4. We've got an office in Berkshire and Central London as well. And we cover a full range of mortgage and protection services for our clients. So whether you're a first-time buyer, you're a portfolio landlord, or you're a commercial landlord, your clients and your viewers can surely get in touch with us. Probably the contact details will be below. The company name is ourmortgagebroker.co.uk.
Brilliant. And I'm sure many of you would have seen Akhil on some of our previous videos. Anyway, let's just dive straight in. Now, a strategy that I've been telling our viewers that they should focus on for 2021 is what they call the BRRRR strategy. So it's the buy and refurbish and rent out, refinance, and of course repeat. And it's a great strategy for times like now. Simply because you want to get in, you want to add some value, you want to refinance, get it cash flow positive and move on to the next deal and do it as many times as you can. The big issue, I guess, the R that I wanted to focus your mind on is the refinance bit of it. Yeah. Of course, when you refinance the property, you do so on the hope that you've added some value. And so how when you actually apply for these remortgages, what are the lenders actually looking for? What are the valuers looking for to see that you've added value to the property since you bought it?
Sure. So for your viewers or any investor that's looking to refinance and recoup as much cash as possible that they've injected, the best way of doing that is physically adding value to the property. And that's going to be substantial, right? You can't add a bit of paint on a wall and hope you're going to get a 20% uplift on the value. So the valuers are smart, lenders are smart. You've got to add substantial value. So the substantial value adds can be done predominantly in high value areas. It's very difficult to pick up a property for 50,000 and hope it's going to be turned around for 85, for example, overnight. So traditionally, valuers will look at it on the basis of substantial value. So it's new kitchens, new bathrooms, new windows, new boilers. So something of substantial value that actually adds value to the street and it brings in accordance to the street value.
So you've typically bought the property with some kind of bridging loan or cash or private investor funds or whatever. You've added some value and 6 months' time you're refinancing it. At that point, when the valuer comes in and assesses the new value, how do they determine the value you've added to the property? Because some of it might be just by buying well. You may have bought it at a discount to market value.
Yeah, and I think that's a great question. So what I would say is, when you have a date for valuation, I would suggest you as an investor or the homeowner be there on site because you know that property well. And what I would say to all my clients is when you're remortgaging a property, look at it as if you were selling a property. So create a pack, walk the value around and explain to him the before and after pictures. So you may have pictures because that's shows the legitimacy of what you've done. Show them around the property, show them where you've added value, how much have you spent on the property and the reason why you've done it. And that way you're reassuring the surveyor that they're going to give you the right value in line with how much you spent on it. And the key here is, you remember, you always want to buy property. You don't want to buy the most expensive property on the street. You probably want to buy the least valued.
Yes.
And that's where you're really going to see an uplift and your money really working hard for you from an investment stance.
What about loan to values? I mean, 75% has been pretty much the norm in terms of the percentage of the valuation that you can borrow on buy to let. Is that going up, down, staying the same?
Yeah, so we've had a lot of that during this year of 2020 for sure. So everyone's obviously well aware of Q2 and Q3 of 2020. Lenders did recheck and reduce a lot of their loan to values. But the good news is we're in Q4 of 2020. Lenders have gone back to pre-COVID times. So loan to values are a lot more higher. We've got great buy to let products out there now, with the latest introduction of an 80% buy-to-let property product out there, which is great for the market, and it's got great rates.
It's nearly back to the golden days where we had 85% buy-to-let mortgages.
We're nearly there. Yeah,
nearly there.
It won't be there for long.
But what's the price of that? Is it coming at a premium in terms of fees and in terms of repayment rates?
Yeah, so a lot of the high loan to value, so in particular the 80% range, you're not going to get it on the high street just simply because the risk appetite is not there on the high street. So it is predominantly those specialist lenders that will offer the 80% rates. Now, the difference between a high street rate and a specialist lender, the margin is actually squeezing, and it's happening on a daily basis. Albeit that what we're seeing during 2020, a lot of lenders have priced in risk and potentially a property correction in 2021. So they've increased their rates by 10, 20, 30 basis points. But again, they're all working and keeping an eye on their peers in the industry as well. So going back to the 80% rate, I think there's a lender on the market, as it's quite widely advertised, it's called Landbay, and they offer an 80% rate. And from memory, I think they've got a 2-year fix at 3.79. And you're well aware of a lot of clients are now buying in a limited company, and buying in a limited company does start with a 3 anyway. So
yes.
Pretty keen rates.
Okay, now that's pretty good. That's pretty good going. What about the process though of applying for a buy-to-let mortgage in 2021? I mean, it seems almost as though some mortgage application forms ask for inside leg measurements these days.
Yes. And the first thing, a lot of clients do ring us and say, traditionally I've always gone to the bank. Why should I use you? And I say, Mr. Client, well, you've now taken the time out to call me, so what's the reason for that? So I sort of give a bit of a pushback. And I think in today's day and age, because we do this for a living, if I was a regular investor, I would not go to the bank directly, because first you're going to have to wait 2 weeks for an appointment. They're going to ask you so many questions, so much paperwork and so on. Leave that to us. That's what we do for a living. As much as we love it and hate it at the same time, there's tears and there's happiness in all this in this business. But all I say to our clients is, use and abuse us. We know what lenders want. We know what the expectations are. And we'll package the case in such a way that it gets underwritten and assessed on day one, if you like. So there's not too much toing and throwing. So we work quite smartly at OMB, and it's all about working with the lenders. And because we've got our ear to the ground, we understand what's needed. So if you're self-employed, we know what's required. If you're employed, we know what's required. If you're a portfolio landlord, we know what's required. So it's just working smarter. And if you think it's hard now, I tell my clients it's only going to get more and more quirky and technical. So leave the stress to us.
I do understand what you're saying, because sometimes when you deal with banks direct, it's drip feeding. They drip feed their requirements. Can you send us this? And then next day, okay, you send us that. Can you send us this? And why don't you just tell me what you want in totality. So what you're saying by packaging it up, that lender X wants this, this, and this, and that's what you ask for up front.
Yeah. So some lenders are pretty good. So on their intermediary websites, they've got a submission guide. So we know if it's a tier 1 product or a tier 1 client, that we have to provide them with A, B, and C. So that's great. But because we are constantly doing business with numerous lenders, and if it's a portfolio landlord, we know what lender ABC needs. So it's all about working smart, and that's what we want to do. We want to make the transaction as seamless for our client, because we want them to come back to us again, and we want to impress our clients. So that's key for us. So for us, it's taking the stress away, the finance stress for our clients. We want them to take their time and efforts to go and find that investment property, and that's what we say to our clients. You spend your time finding the property, leave the finance headache to us. That's what we do best.
Okay. Another major area of questions came up around valuations. Because when the market's going up, of course, if you get a property valued, the valuers have a little bit of a different attitude because their indemnity insurance policies aren't at stake really if the market's going up 7-8% a year. But if the opinion is that it's not, then they think the other way.
Yes.
What are you finding in terms of, people are buying a property for 100 grand? Are they getting those valuations or?
Yeah, it's a good question. And I'm not going to lie here. And we don't get, maybe 1 or 2 in 10 don't come on point. And that could be for a purchase, it could be for a remortgage. And there's multiple reasons for that. So again, it comes back to, if you are remortgaging a property, make sure it's dressed well. Dress the property as if you're going to sell it. Walk the surveyor around, tell them how you've added value. Tell them for sold prices across the road, what it's sold for, what it's rented for.
Won't they have all that information on their databases?
You know what, we hope they do. But what I like to say is reassure that surveyor so you know more about, you don't want to do the surveyor's job. You don't want to think you're bigger or better than him or her. What you want to do is talk to them about your property and just reassure them that this is the right value for this type of property. And the best way of doing that, as I said, make sure it's clean, make sure it's bright, make sure you've got access to all the rooms, and let your tenants know that the valuation is occurring on Monday, for example, at 10 a.m.
So the main difference between a buy-to-let mortgage and a residential mortgage, of course, is that when the valuer goes in, on a residential mortgage, they're looking at the bricks and mortar value of that property based on comparable properties. But if you're looking at a buy-to-let mortgage, then the rental valuation is also an important thing. And of course, we've had a tough year with COVID and all of that. And there's some parts of the country, London, some cities, major cities and towns and things, where rents have been challenged and they've actually come down. So you've got the spectre of people who are going to remortgage a property now. And when the tenant moved into the property 2 years ago, they might have been paying £1,000 a month. But today, the market rentable value is £900 a month. They're looking to remortgage. What's the valuer saying? And what do they do about it?
Yeah, that could be quite shocking to the system. It does come up, it has come up, and it has come up in 2020 in particular. The quick fix is potentially refinancing rather than a 2-year on a 5-year deal. Now, in short...
So why is that? Why would just extending the loan term make a difference?
Yeah, that's a good question. So the reason for that is, in the buy-to-let space, lenders calculate 2-year fixed deals and 5-year fixed deals with 2 different metrics. Now, traditionally, most buy-to-let lenders on a 2-year fix will use a coverage of between 125% and 145%.
Okay.
And then what that means is they'll actually stress it on a 5 or 5.5%.
Just for the viewers, just explain what loan coverage actually means.
Right. So traditionally, every buy-to-let lender stresses the product and the deal on potentially on 2 different products, a 2-year fixed and a 5-year fixed. Now, if you borrow on a 2-year basis, the calculation is less less popular in terms of loan size. They calculate it less advantageous. Now, on a 2-year deal, typically it's between 125 and 145%, which is stressed out. And that's dependent on your tax status, whether you're a low rate or a high rate taxpayer.
So the rent then has to be 125% to 145% of the interest payment that you're paying.
Correct. And that's at 5 or 5.5%. Yeah. So going back to your example, if the tenant's always paid £1,000 and the surveyor goes and he says, oh, this property's only going to fetch £900 in this day and age, it might blow it out from a calculation on a 2-year fixed deal. So the client might not be able to get the loan amount required because of that difference of £100. And it does happen. Now, there is a solution for that. And as brokers, we look for solutions because things can happen and we can have downgrades in value. So the solution potentially in this example could be potentially for a client going onto a 5-year fixed product. Now, the client may not have wanted such a fixed product. It ties them in for longer. However, it gets them a larger loan amount. And the simplest reason why they get a larger loan amount is because lenders on a 5-year fix are a bit more relaxed and they're a bit more favorable on loan sizes that they can offer. And typically when you borrow out a 5-year deal, typically with most lenders, they will stress it at 125%, whether you're a high rate or low rate taxpayer. And then they'll stress it at what we call the pay rate. So that's the rate of interest for 5 years.
Okay.
So it can be a lot more beneficial, and that's the solution, right? So these things happen, and we've always, in today's world, you've always got to have a plan A, B, and C, I tell my clients.
Is that stress testing the same for limited company loans? Because of course, all companies pay the same rate of tax.
Yeah, so limited companies are a great space. At the moment, it's very much a place where many investors are investing. And the reason for that is, the difference, as we talked about there, is you've got thresholds on 125, 145, whereas in a limited company, whether you're borrowing at a 2-year fixed or a 5-year fixed, it's always stressed at 125 for a single dwelling property. There are some variances in that. It could be 130, 135, depending on lenders. But the industry standard on a limited company basis is at 125%. So it's a lot more favorable borrowing in a limited company entity.
Okay. Listen, one of the other strategies we're advocating is to do some, sometimes a little bit more works to a property, perhaps, maybe a permitted development extension or something, and then look to sell the property on. So you don't really want to be tied in for a long time. So a lot of mortgage products come with the early redemption penalties and charges, which can be quite onerous, sometimes 2-3%. Yes. If you want a loan and you may want it just for a year and a half, you want that flexibility to get out. Is there a mortgage product that you can go to as opposed to going for bridging?
Yes, great question, and it's something it's quite trending at the moment, and we see a number of inquiries if not on a weekly, on a daily basis. Now, mortgage lenders ask us, mortgage brokers, they're asking us what type of inquiries are you seeing, what the trends are in the market, because they can adapt to investment styles. So we're always in dialogue with numerous lenders, and they're asking us, what can we do differently? How can we be ahead of the pack and their peers? Now, what we always tell them is that let's bring out innovative products out there that are going to get them more business. And the best way of doing that is we're seeing, as you mentioned in your BRRRR video, which is fantastic, and I found that really, really insightful.
I haven't done any BRRRR videos. It's not that sort of channel.
Sorry, my apologies. But it's a bit of humour. Hopefully I'll get a couple of extra likes for you, Ranjan.
I don't like to do videos that go tits up, but carry on.
Oh, that's all fun and games. So, where was I? So yes, lenders are doing some innovative stuff, and they're asking us of products that they can bring into the market. So traditionally, to do the buy, the refurb, the refinance, the renting, the practice, you had to go down the bridging route, and that's quite onerous, quite expensive, and so on and so on. So there are a number of lenders out there that offer buy-to-let products without any ERC, so without any early repayment charges, and those products are really, really favourable for those investors that are doing the flipping, the trading, the buying, the refurbing, the refinancing types of investment properties. So rates are really key. They're 3% odd. There's no tie-in periods. You can refinance at the uplift value once you've added the value, which is fantastic.
Are the lenders okay with you using it serially, or is this something that you use one or two and you do it once or twice and then?
Yeah, so I've spoken to numerous underwriters, and they don't like it, to be honest with you. And my pushback.
Why do they offer it then?
Exactly, and that's my pushback. It's like, well, you've advertised the rate, you've offered no ERCs. Clients are going to jump on this, and I think their attraction is it gets them market attraction, it gets them the views, it gets them likes, it gets the applications in the door. So I understand from their perspective. And I say, well, if a client chooses to do this down the line, it's up to them. So potentially what that might mean is we might not be able to refinance with that same lender. We'll just remortgage them to another lender. However, it won't affect any credit.
So I think what you're saying is that this is a bit like when I'm getting a mobile phone, unlimited text, unlimited minutes, and then right at the bottom in small print, fair use policy.
Yes.
So there's a fair use policy, and if you're serially getting a mortgage and then refinancing that property after just 5-6 months, and you're doing that several times with the same lender, they'll probably say, look, fair use policy.
Correct.
It's not what it's for.
Yeah, you've got to be smart about it. And we're not going to tell the lender that you're going to be refinancing immediately, or that's the ambition, but we'll work with you, we'll work with the lender, and we want to marry everyone up together and do it in the right fashion.
Okay. I mean, a big issue for lots of people has been obviously Grenfell and all of that, and I think the government have gone a little bit overboard, actually. Any tall building, even if there's hardly any cladding at all, or sometimes just decorative wall panels. I've even heard of buildings where they've got zinc panels on the outside, which any GCSE chemistry student will know is non-combustible, but that needs a full EWS1 form. EWS stands for the External Wall Survey, so the government have asked for these forms to be filled in by surveyors to basically say the sky is blue. In other words, there's no combustible wall cladding. That's all good and well, but there are so few qualified surveyors that it can take up to 10 years to get a survey done. And without that, it's difficult to get a mortgage. And as such, a lot of people are being trapped in flats and things that they can't sell. It's affecting owner-occupiers quite severely. What's your take on this? What are you finding? How is it changing since beginning of the year when it was really quite bad?
Yeah, no, it's a big issue, to be honest with you, in the UK market, and it's parts of the country where owner occupiers, as you said, cannot refinance, cannot even sell the property. More importantly, they can't sell and move on. So it's a big issue. Now, we speak to numerous lenders, and actually yesterday I had an inquiry of a client wanting to buy a block of flats with cladding issues. And my first question was, when was it built? How many stories is there? And has it got an EWS1 form signed off, and is it still valid? Because some of your viewers might know it needs to be valid, and it's got a validation date for 5 years. Mm-hmm. So the answer for all those questions were no. So I said, unfortunately, there is no lender in the market that will lend on a traditional mortgage basis on that property. So it unfortunately didn't go anywhere. But it is a huge issue. There is no fast rule on lenders' appetite. It's not by law. Some lenders want an EWS form completed no matter how many floors, how old, whether it was made yesterday or in the 1920s. Some lenders have taken a view, if it's 8 stories, if it's 18 stories, if it's 3 stories, we need an EWS. So it's very much subject to the property in question. What I would say is anything that was built in 2020 and going forward, they won't be an issue. But anything historic, and historic I mean from just last year, can potentially become an issue tomorrow. But what I would suggest is speak to the freeholder, understand if they've had cladding issues, are they having cladding removed? Is it going to be removed? And more importantly, has it got the EWS1 sign off?
Yes. So it's going to be a little bit problematic for a little bit of time to come, really.
Yes, I certainly agree.
So, I mean, generally, if you are looking for a property, if you're looking to buy a property and it's in a flat with cladding issues, then I'd be, even if you're getting it at a fantastic price, be very wary, because if it's actually got cladding, there's going to be a massive bill to pay in order to get that corrected.
Yeah, that's true. And there is talks of the local council supporting it, and there's grants available for the freeholds to change the fascia of the property and so on. But again, who knows when and how long.
I think the problem with that is the government's said there's a £1.5 billion pot, and it's dropping the ocean to what's required.
Yes,
that's the massive problem. But I think if it's actually got cladding that is offending cladding, then that's an issue. There's going to be massive service charges to put those right. But there are buildings that are ensnared by this new rule that don't have any cladding at all, quite frankly, where the owner is trapped because they need this form to say that the wall is safe, but they don't have it. But with those people, potentially there are opportunities there to perhaps pick them up cheap and then wait till the problem's fixed.
No, I totally agree. And as I said, one of my clients rang me yesterday. He was getting a great deal on a few apartments only in North London. So it was really attractive from an investor's perspective. And what I said to the client was, it looks like a no, and not going to have legs on it. But obviously, we're here again to find solutions. And I said to the client, I've got 2 potential lenders lined up for you. It's going to cost you an application fee and it's going to cost you a valuation fee. It's about 400 quid. Is it worth it? And he's taking a view. He said he'll come back to me on Monday. So again, it's never a no. It's always a potential yes in the future. But sometimes you have to spend a bit of money to gain in the future. So he's going to go away. He'll have a take on it, a view on it, and then come back to me on Monday. So there is a potential that it can happen. But again, as I said, it's subject to the property itself. And again, if there's another block next door to it that has got cladding and the one that you want to buy hasn't got any cladding issues, again, it's up to surveyors' comments. And there's always a caveat with every lender. It's So subject to surveyor's comments.
So you really got to get that survey done. That can cost 700-800 £, and then you don't know until you get the thing back.
Yes, so it can take, I don't know, a couple of weeks or so. So it's an active.
But are they cautious? I mean, do you find they're just overly cautious because ultimately it's their insurance on the line? So they'll, if there's a doubt,
yes,
they would go on caution.
Yeah, and every insurer is going to take their own caution, and especially with the sadness that happened of Grenfell, nobody wants another fiasco like that to happen, unfortunately. So everyone is treading on the line of caution there for sure.
So tall buildings, flats can be a little bit of a problem right now if you're relying on mortgage finance.
Yes, definitely. But again, get in touch. We'll see what we can do for you.
So bounce back loans then, we did a video earlier this year talking about how bounce back loans can help businesses and property businesses. Of course, bounce back loans were never for using as property deposits. That's not what they're about. But if you have taken a bounce back loan, perhaps in another business or in a property related business, and you're not, what is the lender's attitude to it? Because some people have been saying, hey, if you've taken a bounce back loan, kiss goodbye to getting a mortgage. Is that the whole story?
To be honest, it's not necessarily true. Now, everyone's taking out bounce back loans for numerous reasons, and a lot of the reasons for our clients taking out the bounce back loans is for a contingency. And what they've done is, because they don't know how long COVID's going to last, whether they're in retail, how long the shop's going to be closed down for, are they going to see any income during 2020? So they've taken these loans as contingencies. Now, there's nothing wrong with that. Now, I have numerous calls coming in on a weekly basis, and clients ask me, we've got a bounce back loan, can you help us buy property? And my first question is, what industry are you in? How many bounce back loans have you taken? And is this the only form of deposit that you have to buy your investment property? So the key here is to understand the clients, how deep the client's pockets are in the first place. So let's say, for example, the client wants to buy a buy-to-let for 400,000. He's got 2 bounce back loans. That's equated to 100,000. And all he has in his pocket, including all his life savings, is just that 100,000. The lender's not gonna like that, because he's using government taxpayer money to go and fund an investment property. However, if he's got 100,000 bounce back money as contingency, it's sitting in his bank account, and he's also got another 300,000 in his account through surplus rental income, investment income, business income. That's got legs on it. It makes sense. He's taken a contingency as a sideline, but he's also good for it because he's got the money in his bank. So always, we like to work with our clients. It's never a no on the first question. We like to probe, ask them the reason why, find out a bit more about their background, and see how much cash they've got in their bank.
That's exactly what I've found, really. If your bounce back loan is equivalent to the deposit you need to buy the next property, and that's all you've got, and forget it, quite frankly.
Yes, and it's definitely going to be turned away immediately, and we won't entertain it either.
And I guess the related question is the mortgage holidays, because I think when you mentioned people did the bounce back loans as a contingency. I think when we went into the first lockdown in March 2020, the situation seemed dire for people, didn't it? And people didn't know what was to come. Mm. And I remember seeing news reports saying that this is going to be 2 years. Mm. So then the government said, okay, there are going to be issues with rent, and there's going to be issues with evictions and all of that, and mortgage, but householders can get a mortgage holiday. So not a let off, it's just a deferment, isn't it? Correct. And then that would also extend to buy-to-let mortgage people as well. And a lot of people took those as a precaution, as a just in case. Most people didn't end up needing it, but they took it just in case. Mm-hmm. Now, is that coming back to bite people in the bum?
The long and short of it is, it depends on your individual circumstances. Now, I always advise my clients, don't do it unless you really need to do it. Now, again, everyone's got their own household expenses, everyone's got their own income levels and so on. But again, lenders are all asking that question. Has the client taken a mortgage holiday? Has a client taken a bounce back loan? And it's in every application now. So whether you're buying your home or a buy-to-let property, it's in every question. And predominantly those questions are faced for those that are self-employed and the portfolio landlords in particular. But yes, it does come up in the questions, and the lenders need to know why it was taken. Are they now off the payment holiday? Have they topped up their mortgage by the amount that they've missed out in the last 3 months, 6 months, and so on? And where are they tomorrow? And a lot of the lenders have got a caveat or a point in the question to say, if we offer you this mortgage tomorrow, are you going to ask for a payment holiday? And if they say yes, potentially, or they get sight of that, then they won't offer on that mortgage. So just to reiterate, they do ask the question that we're only going to offer you this mortgage subject to you not taking out a holiday tomorrow, because the last thing you want to do is provide a mortgage and the following month you put in a call in and say, can I have a holiday for another 3 months? So yes, it's not well welcomed anyway by any lender.
I guess a related question is, when you're putting in a mortgage application, let's say it's a remortgage, how interested are the banks in the rent payment history on that property over the last year, and also other properties in the portfolio? Are they looking for detailed breakdowns of what rents you've had in?
So if it's a portfolio landlord, lenders do want to know what the portfolio schedule does look like. They want to ensure, do ask questions around monthly payment to the lender, how much rent is received, what's the property address, and what term that you're on. So property portfolio schedules do need to be sent to every lender for every portfolio landlord. With regards to the payment holiday, the audit of receipts of income from the tenant, yes, it is a question that's asked. The lender does ask for 3 months traditionally of bank statements, and that will show income in from tenant A or tenant B or tenant C. So they will ask for it and ensure that rent is being received, ideally by standing order or backs payment, into the landlord's personal or business bank account.
So limited company mortgages then. I mean, when I started in property, of course, very few people were getting mortgages in limited companies, and it was exceptionally rare and hugely expensive. Now with incorporation, many landlords will have incorporated their portfolios. People starting out invariably are doing so in limited companies. Are you finding that switched? I mean, what percentage personal to limited company mortgages are you doing?
Yeah, so I would say a huge amount of inquiries do come in around the limited company space, and a lot of them watch your videos and they talk about the advantages of purchasing property in a limited company. And again, it is very much subject to
what's the split? 80-20, 70-30?
I think the inquiries are probably about 80-20 in a limited company space. But again, those are the first timers. Should we enter in the limited company space, or should we buy our first one in their personal name? So a lot of the portfolio landlords know what they're doing.
Yes.
They've taken up the relevant advice, they've incorporated, so they know what they're doing, so it's a limited company. But again, when there's new entrants into the market and they're buying their first or maybe their second buy-to-let property, they ask, should we buy in a limited company? Now, we're mortgage advisors, we don't give tax advice. So what we firstly do is speak to an accountant. Well, what advice have you taken up? And as experienced brokers and transparent brokers, what we do is we give them two options. We give them a personal named buy-to-let option and a limited company buy-to-let option. So they understand the amount that they can borrow in a limited company, the amount of interest that a personal name mortgage can cost them compared to a limited company, so they can compare apples with apples. And as everyone knows, limited company might not be the solution for somebody on day one in where they are in their investment journey, or even in their income journey at the moment where they are on an employed salary.
Limited company mortgages are still a small premium, though, to in your own name.
Well, the rate's being squeezed, right? So limited company rates were pretty sky high compared to personal name buy-to-let mortgages, but those lenders are becoming more, the rates are becoming more keener with the limited company space, and those numbers are now being squeezed. So the difference between a personal name mortgage and a limited company mortgage can be as little as 1% in between it. And the advantages potentially in a limited company can be great.
What I want to know is, why isn't it the difference between limited and personal mortgages naught?
Yeah.
Because I don't get it, quite frankly, because if you buy something in your own name, you got the Section 24 tax. I mean, the landlord is in a far more fragile position than in a limited company. I don't get why there should be a premium at all. Do you have any insights into that?
I think the only answer I would give is I think lenders are acute and they know why people are buying in a limited company. And the simple reason is because there's more that they can offset from a tax perspective. So lenders think, well, if the client's saving money on tax, how about we up the rate of interest on our limited company range to offset the difference? So I think it's more around the
they can get away with it.
They can offset it, and that's where. And the other question is, specialist lenders have different funding lines. Not all lenders have a deposit book. So if they're borrowing from hedge funds or peer-to-peer lenders, the cost of them borrowing those funds can be quite dear compared to a high street bank using, our savings, if you like. So I think you've got to just mindful of the risk, their funding lines, how they're funded. So they price that in that perspective as well. Okay,
and finally, I think I mean you deal with investors all the time, buy-to-let investors all the time. What trends have you noticed in investor behaviour over the last year and going forward? I mean, let's start with areas. I mean, do you get many people doing buy-to-lets in London?
Yeah, you know what? I think London's been dying off. It's been dying off over the last 18 months, I would say. It's not just 2020. In 2019 in particular, those high-value Zone 1 postcode areas, there's not many buy-to-let inquiries. We do get them, but traditionally and most frequently, we're seeing buy-to-let applications in Zone 2, 3 and outside central London. And I think there's many reasons for that. And the examples are here for 2020. People are now working from home. People are thinking, we want to move to a greener side, more quieter, more rural areas where they can get good value for money. And no more in the smoke, don't have to worry about parking and so on. And we've got friends at Savills in Knight Frank, and they talked quite greatly about this. And I was in a meeting with them last week, and a lot of them said there's been a huge uplift in their clients moving out. Before it used to be a 60-minute commute to London.
That's very true.
And now they want to move to 2.5, 3 hours away because they know they only have to go to Central London office once a week now. So they're thinking, I can get 3 acres of land, it's a 10-bedroom house at the same purchase price that I was buying in Central London. Why should I do that?
No, you're obviously talking to the directors there, the companies, as opposed to the someone in the admin pool. But what would you say is the average purchase price of buy-to-let investment property from the inquiries? What sort of price range are people picking up investment properties for?
Yeah, that's a great question. So we get a varies in ranges of our mortgages. So we've done mortgages at 50,000, but we've also done mortgages at 2.5 million.
What would you say is that the bulk? Spot? Yeah, the sweet spot. The 60% of inquiries are coming at between this price range and that price
I would
range.
say typically it's not a huge wide spectrum, but I'd say anything between 150 and 350 is quite a good sweet spot for us.
That's the sort of sweet spot.
Yeah, right. 150, 350. So you can see our client base is traditionally southeast based. We don't do too much typically sort of Manchester and beyond. So our client base is southeast, but again, we service clients all over the place. We can work with anybody remotely, so it's not a problem.
But that's roughly what buy-to-let would work at. Now, are you finding people are going for single-family let buy-to-let mortgages or HMO type or mini HMO types? What's the sort of split?
So it depends on the client themselves. So if a client's portfolio landlord, it's good for them, and what they're doing is having a diversified portfolio. So some are in the HMOs, some have got single dwelling ASTs, some have got Airbnb, some have got student let. So it depends on the risk appetite and the type of client that we're dealing with. But a lot of the new entrants into the buy-to-let space, they're going for the single dwellings. And the reason for that is simply because not necessarily they can get a HMO mortgage because the lender don't meet the lender's criteria. So if you are a first-time buyer, you're living with parents and you want to buy your first buy-to-let, it's going to be very difficult to get a HMO mortgage because how are you going to prove and provide experience how you've done it before? So it's a bit of too much of a step up. So a lot of the entrants are going into single dwellings because they have to meet the lender's criteria because ultimately they're looking for funding, say for example 75%. So new entrants are looking for single dwellings. A lot of the experienced landlords are diversifying either into HMOs or they're now moving into the commercial space. And they're looking for those office to resi conversions because they want to just go up that notch and seeing a bit more meat on the bone on that end.
So with buy-to-let, the sweet spot, as you said, 150 to 350, that's roughly what it corresponds to. If you look at the rental values, that's pretty much what the lender's criteria, it basically works in that sort of zone, doesn't it?
Yes, it does. And for your viewers that are new to the game, don't get me wrong, there are lenders out there that have a minimum loan size or a minimum valuation of 50,000. But you've just got to be conscious of what your game is. You know, if you're looking to buy property, add a bit of value to it and then refinance it. Just be conscious of the resale values or the remortgage valuations, because you want to, maybe the idea is to take your money back out, as you talk about in your videos, take the money out and go back again. So just be conscious of the end game. And I always say work back with the goals, because you don't want to just put your money into one property and you can't take out as much as you wanted to in the first place. So numbers are key. Maybe you might need to save a bit more money to get a slightly larger property. But again, give us a call, work with us, tell us what the ambition is, and we'll work with you and try to grow your book.
Your portfolio investor clients, are you seeing much remortgaging to kind of raise a war chest?
Yes, so you know, it's widely talked about. The yields in London and the southeast are not great. You know, it's all single digits, 2%, 3%, 4%. There's lots of great commentary online and in the media. There's great yields to be had in the Midlands and the northeast, which is fine. But again, a lot of clients are now looking for cash flowing property. And I think that's the right attitude to have in today's times. Mm-hmm. Don't look for properties for capital growth, because those double digits are pre-2008 recession. You know, that it's very hard to come by at the moment. So don't get me wrong, you can still make a good load of money on properties. But if you buy right, you buy at the right price. You know, if you're finding a probate, a distressed seller, or an auction buy, there's some great nuggets out there. But it's how hard you work for it and how much you want it. And don't get me wrong, as I said, you can make money. You can make 100 grand on a flip. It's quite easy to do, but there's not so many out there than there was 10, 15 years ago. So I always say to the clients, look for good cash flowing properties, but look for properties where you can add value. Avoid potentially flats, you know, look for houses where you can use the PD rights. You know, you can add 2 stories now through PD and so on. So look for opportunities where it's going to cash flow, wash its own face, and you've got potential to add value, add another room, because the more rooms you can add on any site, that's where the real value is to be added, right? Rather than just tying up a kitchen or a bathroom. But, you know, add value by adding rooms with a window, because not classed as a bedroom without a window. Is that right?
That's true. Yeah. That's true. So 2021, do you think it's going to go to hell in a high cart? Do you think we're going to crash or what?
You know what, if you asked this in April, May, I would have said, you know what, we're going to have a huge recession, because everything was turmoil. Everyone thought, you know, the world was coming down, but the banks have switched on. We've really turned, everything's just gone so fast in the last 6-7 months. So I'm really optimistic about 21. House prices, and I think the national average is now 245,000. Mm-hmm. Pre-Lehman's, it was like 115, 120,000 pre-2008. So the price has grown in 15 years by double the national average, which is huge. I honestly still think, I'm a huge believer, and I love UK real estate for this reason. It's a great place to invest. I think we're going to have a lot more foreign buyers coming into the UK. I know they're probably going to be after the super prime stuff, but I think with the pound devaluing, and I think there's a good chance of that happening going forward. Sorry to talk all this economic stuff, but I think it does play in a point, and it does play a huge point, because if the high value properties tank, that's how the rest of the market gets stimulated. Yes. Things move a lot quicker. So it's all about, keep your eye on the markets. You know, I always say, if whatever America does, if America sneezes, everyone gets a cold. So just be conscious of what's happening around us. We've got Brexit, we've got furlough ending, we've got the Help to Buy ending, we've got stamp duty ending. So I always say... Possibly, yes. They might do something. They might twist something, yeah. Oh, you got a quick dial into Rishi, have you?
Sorry?
You got a quick dial into Rishi?
No, my black book doesn't extend that far yet.
But no, listen, I think 21 is going to be a great time. And I think this decade here, where we are now, I can see this being what we were in 2010, 2011. I think it's a great, what you say, the window of opportunity.
Yes.
And you've got to put your entrepreneurial hat on. You know, there's so many great tools out there, resources out there, free advice, free content. You know, rather than watching Netflix. Like
on this YouTube channel, subscribe and like and comment and all that.
And do subscribe. He wants to get to 50,000 viewers. One day. You know, it will happen. But I think this is a great opportunity. I'm a big supporter of UK real estate. I think prices will only inevitably go up. So I think now's the best time to buy. You know,
and you've got this, Boris has said his initiative that he wants to allow first-time buyers to buy with 5% deposit, second-hand property, not just Help to Buy stuff, but second-hand stock. by basically the government will guarantee the rest of the deposit.
Yeah.
So that's going to have a huge effect on the property market.
No, I agree. And I think any incentive that the government throw at anybody, I would say absorb it, take it into account and see if it's advantageous to you. Everyone's got their own scenarios. I would say Help to Buy is great for so many people. Shared ownership is great for so many people. But it's all about timing, where you are in your journey, whether you're getting married, whether you're buying your second buy to let. It's all about working with your journey, with your family, with your loved ones. But no, listen, I'm a big believer. I think the government have to, and I think they will throw out more incentives during 21. It's just a matter of time to understand how, when and why they do it. You know, PD, they've made a great announcement in the last couple of weeks around permitted development. So it's inevitable. You know, we've got a shortage of housing. We've got an aging population. I think they've got no choice. Like England's not getting any bigger in size, right? So more towers are going to be going up. More flats are going to be going up. But I think I still, big believer, 2020 has seen a huge uplift in buyers. Things are coming on the market. They're moving very quickly. We've got great estate agents that we work with and they're saying the same thing. It goes on Rightmove. A week later, we've had 10 viewings, offers out, we've exchanged. You know, it's fantastic. So I think the demand's there. I think the demand's going to be there to stay. I think you just got to do your research, you know.
Yes.
Do your research. There's plenty of bargains to be had if you're an investor.
Plenty of bargains to be had if you're an investor. Do your research. And one place to research is on this YouTube channel. So make sure you browse around at the other videos. Like, subscribe, tell us what you think of what you heard in the comments below. As you probably noticed, this is not a Zoom meet. So we're off down the pub. Until the next video, see you guys soon. Akhil?
Thank you very much. And Scotch eggs on you.
Yes, of course. Yes, substantial meal. See you guys soon. Bye.